Hello and welcome to this webinar on unlocking capital pathways for the energy transition, the latest instalment of our energy transition series. I'm delighted to be joined by Mahal Shah, Investment Director at Gravis. Mahal has over 15 years of experience in the energy and infrastructure asset class, fabulous track record of sourcing and closing some of the trickiest and most innovative deals in the market. Before we come to you though, Mahal, I want to introduce Jenny Evans. Jenny Evans is going to give us an overview of the market and why this is such a pressing issue for investors right now. Jenny is one of the principal associates in our energy M&A team, and this year was selected as one of 25 Law.com Female Rising Stars of 2026. Fantastic recognition for one of the best transactional lawyers in the city, in my view. Jenny, over to you.
Good afternoon, everyone, and thank you for joining this session in the Energy Transition Series. We're focusing today on a topic that sits at the intersection of policy, capital markets, and infrastructure delivery. And that is how we unlock the capital pathways that the energy transition desperately needs. I think it's helpful to start with a number that should concentrate minds. Globally, energy sector capital expenditure reached £2.6 trillion in 2025, and it's on track to exceed £3 trillion by 2030. Under the most ambitious net zero modelling, the energy transition represents a cumulative 100 trillion to 140 trillion investment opportunity between now and 2060, and roughly half of that needing to flow into electrification and enabling infrastructure. That's a staggering sum, and the question of who provides it and through what vehicles has never been more pressing. Focusing on the UK first, we've had quite an extraordinary few weeks for energy policy. On the 16th of April, the UK government announced the removal of a carbon price support tax on fossil fuels used in electricity generation, a mechanism that's been in place since 2013. And then that followed just days later by the Chancellor setting out plans to break the link between electricity and volatile gas prices, proposing that older renewable generators move onto a fixed price CFD rather than earning revenues pegged to the gas set marginal price. Alongside that, the electricity generator levy was increased from 45% to 55% from the 1st of July, and the government has confirmed plans to extend CFDs to operational renewable assets more broadly. These moves come on the back of last year's switch from RPI to CPI indexation on certain renewable subsidies, which had already rattled investor confidence. These are quite significant interventions. They're designed to insulate consumers from fossil fuel price shocks and the Middle East conflict that the Middle East conflict has once again made painfully real. But they also reshape the risk and return profile of renewable generation assets in a way that has important implications for the vehicles through which capital is deployed. The scale of investment needed is huge, particularly in grid infrastructure. Europe alone needs an estimated 1.2 trillion euros of investment in transmission and distribution grids by 2040. And over 40% of European distribution infrastructure is now more than 40 years old and was never designed for the bidirectional, decentralised energy system that we are building. Sovereign balance sheets are stretched after the pandemic, and governments are increasingly relying on private capital to fill the gap. The question is not whether private capital is needed, it's how it gets there. And that question leads us directly to the state of the vehicles that we have, until recently being the primary conduit for retail and institutional capital in this space. The London-listed renewable energy infrastructure sector has had quite a bruising period. As of early 2026, infrastructure investment companies were trading at an average of 18% discount to NAV, and renewable energy infrastructure funds at an average 29% discount. Yet, while the listed sector contracts, new capital channels are expanding rapidly to fill the space. Examples of these are LTIFs in the EU and long-term asset funds in the UK. And these represent a generational shift in how everyday investors can participate in infrastructure. Their rapid uptake suggests that appetite for real asset exposure is strong, And these structures are specifically designed to lower barriers to entry and benefit from regulatory frameworks which broaden eligible assets and reduced investment thresholds. Private infrastructure fundraising more broadly remains healthy, with capital increasingly gravitating towards AI, data centre and power themes. So, in summary, we have a picture of enormous capital need, a listed sector under pressure, and a wave of new product innovation designed to channel private wealth into infrastructure. And the question we will spend the rest of this session exploring is what this means in practice for the different types of investor that are listening in, and for the assets and projects that need their capital. And I'll hand over to Kieran to kick off the discussion.
Thank you so much for that. So as transactional lawyers, we're extremely busy right now, but listening to the scale that's just been outlined there, the figures and the opportunities, just astronomical. There's so much more out there to be done. And a lot of that sounds like it's extremely pressing. So Mahal, if I may, to kick things off, in your view, where are the biggest mismatches? Is it capital availability? Is it project availability? Or is it the risk allocation? Where are things going wrong at the moment?
Well, thank you for having me. It's a good question. If you ask managers, it's really hard to raise capital. If you ask LPs, investors, they can't find, or they're struggling to find what's the best strategy. So, but for me, I think it's risk allocation, hands down. I think capital is abundant. There are good project pipelines out there. They don't always seem to find each other. So let's take this one at a time. If we think about capital, I think LP commitments to energy mandates or energy and infrastructure mandates actually increased. So I think in the last 3 years, it roughly tripled. I think that from our perspective, well, from a transactional lawyer or from one who's finding deals, projects are not exactly in scarce supply either. To put some numbers around this, there's probably close to 600 gigawatts of core renewable technologies in the pipeline. And not all of those are going to be built, not all of them are good, not all of them are viable, but it is multiples of what we need for CP 2030. But there are good developers amongst them, there are good pipelines. So I don't think it's project pipelines either. I think it's probably risk allocation, and I think there's been a retrenchment from generation. Jenny mentioned some recent government updates, but if you think about an investor or a manager over the last 18, 24 months, we've had REMA, we've had the CPI change, we've had a bunch of new announcements. So I think that has kind of added an additional layer of thinking around risk around some of these portfolios. And I think that developers in particular have felt quite squeezed because these announcements have rolled one after another, with some having some quite long dated resolutions, or in the case of REMA, no change really, or no material change. So I think it's really about finding out where or how to cut the right deals where the risk sits in the right place. I think the last thing, which I think is probably a post-COVID era, higher interest rate world, investors want high returns. And I'm not sure that developers, the market managers, are attuned to their need to secure higher returns. And so you've got a bit of a stalemate, as it were. Developers wanting higher outturns for selling projects and investors wanting higher returns and therefore not being able to pay that. So I think there's quite a lot of things going on, but for me it all comes down to risk and the returns associated with that risk.
Fair enough. Okay, so risk allocation sits at the heart of it. No surprises there. And you also kind of touched on kind of a thematic shift that we've seen in particular in the energy sector, slightly infra as well, but particularly in the energy sector, where regulations are up for change. And some of those are good, some of them may be less good, but the fact that change is possible has now become kind of an ever-present factor. Jenny, Coming to you, I know one of the reasons that General Counsel love working with you is you're tenacious with your risk register. You map it all out for people, you show them exactly where all the problems are on a project and how to guide them through it. Without giving anything away on the project specifics, the issues that will come out through detailed due diligence, are there any themes that you could draw out on the sorts of risk items that GCs are asking you about, that they're starting deals asking you about?
Yeah, so I think project fundamentals haven't changed. For every energy project, you need property, you need planning, and you need grid, and they're the key requirements. But we are also seeing increasing questions on regulatory issues and opportunities. So I talked obviously about the key regulatory recent changes from just this month in the introduction. Obviously, these create some uncertainty around the future market design, revenue support mechanisms, and we've seen clients asking how to underwrite assets where we've got the policy framework that's actually really constantly changing. Grid connection reform is obviously still a very relevant topic. We've had significant volume of instructions on that and advised multiple acquirers on projects that have the gate 2 offer in process. The key things that we're seeing there, more deferred consideration concepts. We're seeing put options to sell projects back to the original owner if the gate 2 offer doesn't come through. Split exchanges and completions, obviously. So lots of that type of thing coming through. And last theme, I would say, supply chain risk continues and has continued to have an impact for a while now. So even where a project clears planning, secures its grid offer, clients are seeing 24-month lead times on key equipment, even longer with offshore wind. And that obviously has a major impact on construction timetables and ultimately the commercial viability of projects.
Thank you. So project fundamentals are staying the same, but we're seeing a shift in amplitude on some of those newer issues, with some clients, some investors seeing opportunity with the new investment models that are coming through and being excited about what possibilities that creates, and others, rightly, I think, concerned about maybe traditional issues, but ones that become increasingly important. I think supply chain that you mentioned at the end there is a particularly acute issue right now. So without downplaying any of that, for those investors that are okay with the kind of risk profile that comes with the sector, how can they get increased exposure to energy and infrastructure assets with the right kind of risk allocation?
So there's 4 ways that I think about it. So there's the traditional way. It's committed fund exposure. You're an LP investor. You trust the GP, the manager, to find and lead that strategy and find assets. There's co-investments if you want perhaps alongside a fund commitment as an LP or just specific exposures where the GP has found perhaps a subset of deals that are actually more to your flavour if you've got a bias, for example, towards a geography or a technology. Trusts, and we spoke a bit about the trust disconnect, and managed accounts, where you've got a specific theme you want to focus on, a specific strategy, but all of these have different cost commitments, capabilities, capital requirements, and horizons, so how long. If we talk about the committed fund, I think that's what everyone understands. They have a manager who will have set up a strategy and hopefully demonstrated a track record in that sector, so you can rely on their expertise, I guess, to not only have brought you along as an investor, but hopefully another series of LPs who've all kind of validated the story. And I think you're now starting to see themes within that. So we've seen those that are focused on some signal technologies, some or a kind of narrow subset of technologies, and some which are a bit broader, like energy transition. So it depends what level of diversification you want. But there's lots and lots of GPs out there fundraising for strategies. So if you do have enough capital for that, and that's your flavour, speak to the placement agents. I'm sure they'll be handing your door. The trust market, with a hazard warning that it's disjointed. it feels like investors don't trust the valuations. Okay. Yeah, they're trading at a discount, a continual discount. Jenny gave some figures around that, particularly with the energy trusts. So Gravis GCP Infrastructure Trust has been able to sell assets at NAV, so as what it believes to be the valuation. So that message is getting out there. And I know other managers have also done that as well, or tried to do that. Some of that messaging is sticking, some of it's not. And then the managers are thinking actively about these sectors. They'll take a quick ask of ChatGPT or Gemini or whatever you use to find some high-profile failures to convert to an IPP or to merge. It's well documented. I don't want to talk about any one manager there, but I think that if you can believe the valuation, or you don't even have to believe the totality of the discount, I think there is good yield. Okay. If you're income focused, but I think carefully about what kind of sector exposure you want, whether it's pan-European, whether it's just the UK, and whether it's core plus as well. So I know that the managers have really good people, good projects there. I've Transat sold and bought projects around that. So I think there's I feel a bit sad for the trust market, actually, to be honest. I think it's a bit harsh. Co-investment, fastest route. In theory, it costs less for the investor to access those opportunities. They get concentrated exposure. Just be mindful, you're getting a concentrated exposure, so you're not getting diversification. So to state the obvious, you're getting a concentrated exposure with the risks associated with that. The classic example is if you were buying Spanish solar 2 years ago, and that was your focus, you'd be feeling pretty sore right now.
Yes.
If you're buying batteries in 2018 in the UK, you'd be feeling a bit sore right now, before then gas peakers. So, but there's also the upsides as well, so if you go well. And then managed accounts may be right for LPs who've got a particular requirement, or a shorter time horizon or a longer time horizon, or want to have a value add strategy where they think about something really quite niche. Perhaps they actually have access to equipment or supply, and it's a route to kind of deploy that equipment as well. So we've seen that, and what's great about managed accounts is the manager has origination work, smart corporate finance people, deep knowledge about how other projects are priced, and you can access that immediately rather than trying to build your own direct investment capabilities.
Okay. So lots of different structures out there, and the clearly a dynamic market where people are listening and responding to the requirements of investors and trying to get kind of a tailored solution, which sounds like maybe the intelligent investor needs to put more work into their strategy to make sure they're finding the right product or combination of products to get there. Let's talk a little bit about the investments themselves, if I may. So often we hear from our client base a real ambition for high growth, for greater value, in part based on a perception of what the assets themselves should be able to do, but also by reference to other investment opportunities. For those investors that are looking for the growth that comes from value creation, how can they get exposure to that without just betting big on untested technology or taking a pure play development risk? Are there ways that they can get that growth?
Oh, definitely. So development is a venture style activity. Projects will die. You'll spend a lot of money in planning, studies. The requirements that are needed to take a project to a truly ready to build state, where they're actually saleable, is quite substantive. There is a lot of people who exist in a world where that market was perhaps a bit frothy, who are way ahead of you in terms of project availability or readiness. And I'm not going to touch too much on word reform and readiness, but I think that matters a lot now. But so I think that's genuinely venture style. I think we should think about other value add strategies, and there's a lot you can do. Jenny mentioned supply chain. So there's been a few supply shocks, to say the least. Since you invited me to do the webinar, the world has changed since we've actually done the webinar. So supply chain for me is number one, CapEx, particularly if you're entering ready to build strategies. If you've got a smart manager who can use the fund's balance sheet to forward buy equipment, place deposits, take some of those risks, out of the scope of EPCs, I think that can be really accretive to returns. EPCs, they know this pricing is moving a lot, so sometimes they're not just trying to add margin on existing kit or margin on margin, they're actually trying to build in contingency for that moving and not wanting to sit on that equipment. So using that well, I think is smart, particularly if you're doing something homogenous like solar or BESS, like really establishing frameworks or speaking to specific technology suppliers, and there are good managers out there doing that. And then route to market is one where, depending on the investor appetite and returns, it can be accretive, but often there's a structuring component to it as well. So if you bring in a set of fixed revenues, perhaps your debt terms are more attractive. Developers won't do that because you have buyers with different themes. Some who want the merchant power price exposure to optimize around it because perhaps they're players that they have inherent optimization capabilities. I know financial investors who've paired up with traders. And then that is different strategy by strategy. Some have different preferences, CFDs, PPAs, just price floors for some batteries, tolling. It's evolving very quickly. So that's where you'd want the manager to focus. But for me, I think CapEx is probably the most accretive things you can do. And hazard warning, as Jenny said, around supply chain.
Okay, that's really helpful. So by looking at traditional assets, but maybe expanding your focus a little bit and then really drilling into how you execute quickly. So those with capital that can deploy in a timely fashion with purpose stand to do well here. Okay, I'd like to change tack a little bit. So one of the things that's driving the immediate growth and the opportunities that we're seeing is the rise and rise of data centers. And we are seeing this from lots of different perspectives, and we'll come back to them as a standalone asset class in a moment.
Yeah.
Before we do that, I want to come to kind of the underlying root of that, which is just the volume of data that's out there, right?
Yeah.
So these data centers are processing data, and I'd like your view on the data itself. So do you see the huge uptick in available data as something that is helpful for investors? Is it causing challenges for you? Does it change the way that you need to deal with them? Just the data itself rather than...
So data is great for assets which, on the face of it, don't do much, like a solar farm that has hardly any moving parts, if any. So data is helpful to understand the micro data around what it's doing, what assets, what components are failing, is really helpful for the smarter managers and the smarter O&Ms to work out how to improve performance at an asset level. For investors, they sort of care indirectly about that because they want better performance in their underlying assets. For, I think, investors directly, it's about information around the underlying portfolio. I think this is where, if we think about the trust market, there's a lot of commentary around NAVs and why they believe it, but can they really look through to the underlying projects and know what's happening, see that data as live, or as near live as possible? And it's something actually at Gravis that they've invested in a platform called Carapace. That's really about giving investors a real understanding of what's happening in the underlying portfolio.
Okay.
And I think that signal around transparency is in itself helpful to pursue share price or to one's sentiment around why we would trust one manager versus another. And I think I know that Gravis are particularly proud of it, and we've had that feedback back from investors as well.
Okay, so getting on the front foot and actually showing people the data, giving them the underlying information so they can form their...
And data's not just, how's the asset doing, it's how do we think the asset's doing, it's our commentary around it. I think that's also data as well. Taking that data and making it information for investors.
Okay. Yeah, so usable data rather than raw data. Yeah, okay, that makes a lot more sense. Yeah. Okay, great. Let's get back to the basics for a minute. So how do you see the current risk appetite across Europe right now, across core plus or high risk transition assets? Do you see sentiment shifting as to what people are interested in and what even kind of counts as sitting within those buckets?
So okay, the market is saying that core plus and high risk energy transition is more interesting because they're committing more funds towards it and less funds to core renewables or core assets, but I have a background in core renewables. Core is commoditized, notwithstanding kind of some of the, regulatory shifts that we spoke about earlier on. at least in the UK market, particularly GB, because it's understood the returns are bid down, and that's no longer exciting.
Yeah.
Particularly when we're in a higher interest rate environment. So traditional core has, I think, a price problem. Core plus, where I think is where the opportunity is rising, and with some of the value add activities we spoke around, route to market, construction de-risking, capex de-risking, supply chain de-risking, you can make it closer to core, but still capture some of those returns. That's where really good managers come into play.
Okay.
And then high risk transition, first of a kind decarbonisation. There's some really, really good managers operating in that space, know what they're doing, have achieved higher returns. There, I think you're going to be paying a premium to access it later on.
Okay.
But also, what I've noticed for some of those better managers is they're reaching their hard caps really quickly. So as a new investor entering into that space, you have to write a big ticket,
Okay.
or do something interesting, or actually is that opportunity set relatively small there? So I'm not sure. I like the core plus.
Okay.
Yeah, it's the right balance between the two.
Got it. Okay. And then getting the crystal ball out, if you look ahead to, 2028 and beyond, where do you see the capital going next? What's going to be the institutional core of?
I'm starting to see new route to market products on BESS that I hadn't seen before, across different geographies. I think that makes it more investable for certain types of investors. Certain managers are looking at that a bit more closely, where they've sort of stayed away. Private wire and behind the meter is better and safer and more defensible, because you often have a captive customer there, and there's an element of fixed pricing in there that I think is harder to develop and deliver. But if you're entering into that right entry point, it's helpful, and I think you'll see more of that, as well as I think particularly the corporate community in the UK take more of a front foot in decarbonisation as well. Not from we think it's for the social good. It's become like business critical around de-risking their energy costs, and then the energy parks around data centres, because if you think about Europe, 24/7 decarbonised power is going to require 24/7 decarbonised power. And whilst I did knock that we're not going to build 600 gigawatts of onshore wind, solar and storage, if the build out of data centres based on what is available in the planning portals, for example, is correct, we're going to be woefully short. We're going to have to build far more and far quicker than we currently are. Okay.
So you mentioned data centres, and we're, as I said, extremely busy on that. Jenny, if I might turn to you. You've been working on a number of different types of data centre projects over the last couple of years. How do you see the DC requirements differing from a more traditional renewables project?
So I think the common characteristics, the project fundamentals, again, property planning grid are the same and don't go away, but there's additional requirements with data centres. So power demand, Mahal mentioned that power demand needs to be sustained 24/7. So that's a fundamentally different load profile from a generation asset that exports to the grid. Planning can be more complex with additional considerations like noise, cooling infrastructure, water consumption, that type of thing, traffic. Grid requirements can also be different. So data centres obviously need to have import capacity rather than export capacity like renewables projects. So we're seeing bespoke connection agreements. And then location is a critical variable. So clients are increasingly looking at co-location with generation assets such as solar plus storage to secure power certainty and meet that 24/7 demand.
Brilliant. Okay, thank you. I'm conscious of the name of our webinar is Unlocking Pathways to Capital. So, Mal, I might just ask you the direct question.
Yeah.
What needs to change to unlock private capital?
Simply faster permitting.
Okay.
If we can get some of the basics right around grid portals working, the kind of some regulatory stability, high quality engagement with the development community and the investment community, it's really slow and it's biting. the government seems minded to be supportive. The chat's really good. The chat's really fast. The action is woefully slow. To the point it's a little bit boring now to talk about it. I think some managers are quite good at this. They look at deployment visibility, they look at the better projects, they collate pipelines on that, and then they market that really well. So we should see more of that, hopefully. And then better innovation around flexibility, I think, is helpful. So if you can create something which is merchant, people feeling a bit insecure about it, not comfortable around it, not sure what's going to happen, not least with the build out of more generation. I think some incentives to fix revenues, some attractive pricing could really unlock private capital. And there's lots of chats around long duration energy storage, clear capacity market signaling, but just do all of it faster and harder, I think.
Okay.
Yeah.
Brilliant. Okay, thank you for that.
Yeah.
So I feel like we've answered the direct question that we set ourselves at the start, covered a lot of ground, huge number of structures, asset classes that are available, opportunities that are there, and challenges. And we are up against the half hour. Any closing thoughts you'd like to leave the audience with as a final remark?
So I'm just looking at my notes. No single asset class, number one. I think that all of them are going to play an important contribution to the energy mix. I think if you have one single asset class, you're going to get a very unstable grid, actually. So I think it's about working with managers and sort of ignoring the direct investment route, if LPs have that capability or investors have that capability, who have deep sector experience, have their own kind of view on how this market's going to evolve, and have an established philosophy about how they prosecute investments. I think they'll be the better managers. So focus on finding those managers, and it's not straightforward to find them, but it doesn't take much by way of due diligence to understand that. What's their pipeline? What are they transacted on? What have they not transacted on, and why? Ask that. And what track record they have with institutional capital, I think is probably going to be really quite important.
Okay, brilliant. And if I could just add one thought to that, I think it's about personalities as well as structures and organisations. So you've got to find the right individual that's going to guide you through. Matt, it's been a pleasure talking with you. Thank you very much for your time. Jenny, thank you very much for your comments. And thank you to the whole audience for giving us half an hour of your time. I hope there's something there that was of use to you.